Yeah, look, hey guys, so I'll talk a bit about the market. So it's an interesting market. House prices, what we're seeing at the moment, they're definitely down 10%. So 10% absolute from last year. But the thing I would sort of say is that last year's prices never really sort of showed up in the statistics, because when you get to peak market's one or two sales in a particular area. It's not a large number of sales. And you know, although house prices were very high last year, you know, in large parts of the city there weren't actually large volumes. There were certainly good volumes in parts of the city, but not necessarily high volumes. And so that high watermark was set by a few sales. What's interesting in Auckland is that a lot of the property that was setting that high watermark was development property. So one of the things that we've seen, it's called highest and best use, right? That's what valuers would refer to it as. And we saw a lot of property in areas like Birkdale and Birkenhead on the North Shore, even Glenfield, then right through South Auckland, developers paying sort of $1.5, $1.6 million for 800 square metre bits of dirt, on the basis that they could then do a terrace townhouse development and on-sell it to first home buyers for $800,000 to $900,000. And it's interesting because 2 or 3 years ago, those same first home buyers were buying around $700,000. And as interest rates dropped and borrowing power and affordability improved and borrowing power went up, obviously builders and developers were struggling with building costs, but what they were able to do is increase their prices. And as they increased their prices, that flowed through into land values. And so we sort of saw land values take off. And I think if you're thinking about house prices in Auckland over the last couple of years, I think it's really a reflection of land values, and it's really a reflection of a very active developer market snapping up 800 square metre plots of land. If you think about the change in what's happened in the development market in Auckland, it sort of goes quite some way to explaining it. During the GFC around 2008, 2009, most developers were building high-rise. So if you think back to that time, everyone was putting up buildings in the inner city, and a lot of those developers pretty much lost their shirts. You know, a lot of them went under. A lot of finance companies went under with them. And the guys that survived that have certainly moved away from apartment building, because the development timeframes are long, it's a complicated process, and New Zealand's a very volatile market, and if you get caught in a cycle and you don't have the capital to get yourself out, you get yourself into trouble. So everyone sort of started to see the sweet spot emerging around terraced housing. And Kiwis aren't really ready to live in apartments. You know, we've kind of only just given up the quarter-acre dream. You know, terraced townhousing's really sort of become the thing for first home buyers and entry-level sort of housing. Apartments are just too risky. A lot of our developers simply didn't have the capital to play in that market, and so you've just seen the whole development market swing into townhouse development. And with that, it's allowed a lot more people into the market. So rather than the big traditional developers, you've had literally, we get bombarded by people becoming developers every day now. Not so much now because everyone's freaking out about interest rates, but last year, every man and his dog was becoming a developer. And you know, first-time developers. The number of first-time developers around Auckland at the moment is insane. And so that really pushed those house prices last year. And what's interesting is that inexperienced developers were pushing the prices even higher. You know, we had experienced developers that were just walking away from auctions going, that's $200,000 or $300,000 more than I would have paid for it. And so that was really setting that high watermark last year. And so when we think about where house prices are going, essentially that's the first bit that's dialing back. I think there's significant risk around development land at the moment, in the sense that what would have sold for 1.5 or 1.6 last year might only be worth 1.2 this year, and maybe less if it's got no house on it. So I think the real risk with development land at the moment is where people have got stuck partway through a project. You know, once the house is removed, the only buyer for it is another developer, and that's where you're going to see the real price sensitivity. But when you wash it all up, you're talking about a 10% absolute fall in house prices. Whilst I think development land and what's been going on with development has set the high water mark, it's also helping drag the prices down. Building costs aren't going down, so entry-level housing, the prices for entry-level housing can't really change, right? Because it's uneconomic to build below the price points that we're already at. You might get a bit of benefit with falling land values, but not really material. So, I think build costs and the complexities of building in this market at the moment are sort of underpinning entry-level pricing. So that's not where I think you're going to see much price movement at all. If I think back to Sydney 2 or 3 years ago, they had about a 10% absolute fall in house prices in less than a year. And that wasn't driven by a major recession, it was driven by tax changes and a whole lot of other things that were flowing through the Australian market at the time. But what we noticed is that entry-level prices didn't really change at all. Most of the price change occurred in the higher end of the market, which is what you would expect. At the moment, in places like Herne Bay and Ponsonby, we are starting to see quite significant price movements where people need to sell. Because you guys all know that typically what happens in the New Zealand market is if you don't get the price you want, you don't sell it, you just rent it back out again, right? And that's what we saw post-GFC. That's why New Zealand didn't really have a big price adjustment post-GFC, is that if Kiwis don't have to sell their property, they won't. The difference this time round, I think, so we've got very, very low unemployment. We've got unemployment the lowest it's ever been. That's a strong price supporter. So that supports prices. We've had very low immigration, but we know that immigration is going to pick up. And we know that we generally have a shortage of good property. So for any of you guys that have been in the market over the last 2 or 3 years, you'll know how hard it is to find a good property here. I mean, there might be property for sale, but the quality is generally pretty poor. And finding a good property is really hard to do. There are more good properties on the market at the moment. There are less buyers, therefore, it is definitely a buyer's market. But let's be honest, there's not that many good properties, and it doesn't take much of a swing in immigration for those good properties to just get soaked up. So I pick in any good suburb in Auckland, I could pick any, but pick a Northcote Point or a Westmere, some of these smaller suburbs where there's not a lot of building activity, there's limited housing stock. There might be 8 to 10 properties on the market in these sort of suburbs at any given time. It doesn't take much in the way of immigration for that to disappear. So I think one of the things that I've been trying to say to people that are in the market to sort of buy is that yes, we've had an adjustment in house prices. Most of that adjustment's already come through. The other thing that I would sort of say with that, the media and bank economists are starting to talk about a 20% fall. But you've got to dig into it. They say a 10% absolute fall and a 10% inflation-adjusted fall. Now, hopefully you guys get that. All it means is house prices might drop up to 10%. They already have. Inflation-adjusted reduction in house prices is absolutely meaningless. It doesn't mean anything. If all they're saying is that it would cost less cabbages to buy a house next year than it did today, but it's irrelevant if you own a property, right? It's actually saying housing will become more affordable. So if house prices don't move and you have inflation, right? What happens with inflation is gradually salaries go up, right? Most businesses, in New Zealand at the moment are having to go through a pretty aggressive salary increase cycle because of underlying inflation. So, most business people I talk to are having to increase, wage and salary levels at least 4 to 5%. So inflation translates through to income increases over time, right? Makes sense. And that's happening. It's happening really a lot more than it normally would at the moment because our unemployment rate's so low. Employers really have no negotiating power with unemployment as low as it is. So inflation drives up wages and salaries and costs go up. If house prices stay static, housing gets more affordable. inflation over a long period of time is a way of dealing with the price problem that we've got in the housing market. So, you know, when I keep hearing this 20% reduction in house prices, I think it's more alarmist than it should be. The reality is that all that's saying is we're in a higher inflation environment, and over time that's actually going to do a good job of making housing more affordable. Kind of sounds a little bit contrary because we're all programmed to think that inflation is really bad, and it's not good. The problem with inflation is that it typically, wage increases typically lag inflation, so it causes a cost of living crisis, right? And we're hearing about that all the time, and it's real. But the benefit of inflation is it does slowly unwind this problem that we've got with really inflated asset prices. So I think my sense for the housing market is that I think the media's slow, so you're going to get at least another 6 to 12 months of, you know, probably continuing stories around falling house prices, because typically the statistics that they're looking at are lagging the market by at least sort of 3 to 6 months. So I think those stories are going to continue. I think interest rates are starting to stabilise. I think this is probably the next really big, important point. Look, the Reserve Bank is still saying that peak OCR is 3.5%. Now we're at 2% now. We were at 1.5% yesterday. We're now at 2%. We've got another 1.5% to go. The mistake that people make is just adding 1.5% to current housing rates and assuming that that's where mortgage rates are going. That would suggest that mortgage rates are going to get to 7%. And for most Kiwis that have borrowed too much money, that's a really scary prospect. They're not going that high. So in a normal market, mortgage rates would be about 2% over the OCR. So the OCR is at 3.5%. That says at peak. So it's 2% now. At peak, the Reserve Bank is saying the OCR will be 3.5%. That means you can expect mortgage rates to peak at about 5.5%. It's not much different to where they are now. If you think about it, 3, 4, 5-year housing rates are already over 5. 1 and 2 year rates are still quite comparatively low, around sort of 4.5%, maybe just starting to hit 5 now. It's largely done. So what I think will happen to interest rates is I think you might see them touch 6 because people are still panic fixing. So people are still rushing out to fix because they're still really concerned that rates could hit 7 or 8%, right? And that panic fixing will drive rates higher than they need to go. So I think in the short term, in the next 6 months, we might see some of those housing rates start to touch 6, maybe slightly over 6. But they'll settle down and they'll come back down. And I think you can sort of reliably, as long as the peak OCR, where the Reserve Bank says peak OCR at around 3.5%, I think you can reliably sort of infer that rates will kind of land at about 5.5. They're not going to stay there because the Reserve Bank's saying that they see neutral OCR at 2%, which means they see a neutral housing rate at 4%. So we're already in the tightening cycle. I was trying to describe this to someone today. It's like an engine, and you don't want it overheating, but at the same time you don't want it stalling. And so the Reserve Bank's trying to keep the New Zealand economy going, not overheating but not stalling. 2% neutral or a 4% mortgage rate is where they see normal as being now. So we're definitely in that part of the cycle where we're overheating, they're pulling it down. Interest rates aren't going to stay this high. So as soon as inflation gets out of the economy, you can expect to start to see rates sort of ease back to around that 4% level. The question is, how long is that going to take, right? And what does that look like? Now, my view, and it's not a commonly held view because just about everyone seems to like talking up rates at the moment, is that this economy is slowing down way faster than most people think. I think there's a lot of fake money floating around. The government's printing money left, right and centre at the moment. But you know, those that are in business will know how hard it is. You know, how hard it is when consumer confidence is getting smashed, people's discretionary spending is getting smashed, That money's coming out of the real economy, and it hurts. At the same time, we're facing higher cost increases, we're facing wage pressures. All of this sort of stuff is really impacting business. And the thing with an economy is that there's only one way an economy makes money, and that's by making stuff, right? It's by business. And I think sometimes the government forgets that. You don't make money from tax, right? You don't make money from tax. It's a byproduct of business. And we've got a government, and we've just got a country at the moment that is just not geared around productivity and making money, because that's what drives success. And we've got a whole lot of small businesses out there that are really starting to struggle. And New Zealand is a country of small businesses. Our big exporters, they're probably okay, right? Because it's a commodities boom. We can get record prices for dairy and lamb and sheep, and that's going to be fantastic. And that will flow through into the economy. But, in terms of who employs people, it's hundreds of thousands of small businesses that are facing cost increases, wage increases, lower consumer confidence, and challenging revenue situations. So I guess all I'm saying is that as these interest rates go up, and as consumers, we're already not very confident, that's going to take a lot of heat out of the economy quite quickly. And so my view on that is that the Reserve Bank has played aggressively, and rightly so. But now that the OCR is getting above neutral, I expect to sort of see them start to slowly dial back the rhetoric, especially when we start to see the warning signs that the economy is stalling. And I think that will happen over the next 6 to 12 months. So I would be surprised if we get to 3.5% OCR. My view of it is I think we'll probably continue a pretty aggressive approach for at least another 2 or 3 OCR increases. And then I think you'll start to see the Reserve Bank easing off quite quickly. Now, they're not going to say that today. It'll depend on what happens in the economy. I just think the economy is going to slow down a lot faster than most people are expecting. The only hedge I would put on this, the only caveat that I'd put on it, because no one really, forecasts are invariably wrong, right? The only caveat I'd put on this is immigration. We just don't know what's going to happen with that. We don't know how fast it will occur, when it will occur, and how many people will want to come down here. But what we do know in New Zealand is that when we get high levels of immigration, it's very stimulatory, right? So if we sort of start to get high levels of immigration, that could really put a bit of fire in the belly and could really heat the economy up a bit more. From a housing perspective, it's positive. That would really underpin where house prices are at the moment. Simply because we just don't have enough stock. Anyway, so I don't know, there's a bit of a view on interest rates. I think we're basically at peak. House prices are soft, they're coming off. Look, the other thing I'd say about housing, I think, again, this is just on the ground feeling as opposed to anything I'm getting from the media or anything at the moment. But my sense is that I think as interest rates settle down and everyone realises the world's not coming to an end, and consumer confidence just starts to stabilise, I think you're going to see buyers back in the market. My sense is I'm starting to feel it already. I think we had a really quiet patch earlier in the year that was a combination of triple CFA changes that went through in December, LVR limitations that went through at the same time. We had a bit of an immediate credit crunch coming from Reserve Bank policy and government policy that took the wind out of the sails very, very quickly. We've obviously had this significant increase in interest rates with real uncertainty about how high it will go. But these things are starting to settle down. There's triple CFA changes are coming through in the next couple of months that will gradually solve the problem that we had there, which was the banks just weren't lending at all. LVR restrictions have eased up a little bit since December. Interest rates, as I said to you guys, are starting to stabilise. So things are sort of settling down a little bit. And what I'm starting to see in the market is not large amounts of of buyers in the market. They simply aren't there, but buyers are there. Like, we are still seeing stuff selling. You know, so in our business, last year we were probably writing about 150 million a month in mortgages, so about 1.7 billion a year. This year, on a like-for-like basis, we might be down about 10%. But there's still a lot of mortgages, right? The market's quiet, it's not dead. And as things settle down, I think you'll just sort of start to see it come back to life again.